Welcome to the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. Welcome, you guys. We are also 2/3 of the team at unfilteredinvestor.com with our chief technical chartist strategist, Mike Arnold. Bobby and I in the green room were just talking about hairstyles. If you guys have any input on that, you should. Because here's my contention, that I'm 61 years old and like half my hair is gray. Gray hairs go in whatever direction they want to go in. So my wife liked me with long, kind of curly, a little bit hair, but now it looks stupid. Bobby, what's your take?
Just cut it, man. It's like, it looks like when we're older guys, it looks like we're trying to hang on to something. I remember, do you know Jonathan Farrow, right?
Yeah, sure.
Yeah, Jonathan told me one time, I was with him in New York, and he goes, "What is with you Americans trying to hang on to that silly hair?" Now, it's coming from a bald guy. I get it.
Right.
But he says, over in the UK, we get rid of it. When it's time, we just get rid of it. I don't think that's accurate, but it's accurate with him.
Okay, it's funny is that you say I look like an old guy who's trying to hang on to something. I am factually an old guy who's trying to hang on to something. Like, it's not you look like. People try to insult me all the time. Like, yeah, no, that's exactly what I am. Before we bring our guest on, markets today couldn't keep a bid exactly. Do you think we're in some sort of transition period? What are your thoughts?
All I think this is rotation. I really do. I mean, we're not seeing it everywhere. Some of the defensive stuff that you and I have in the Unfiltered Investor are doing okay. I just think it's pure rotation. I think there's fear that the CapEx and AI can't continue at this level. I just don't know why it triggered now.
Okay, and by the way, I am way too long Micron, but not because I bought tons of it, just because I had some of it, and then all of a sudden my little sum of it became into a lot of it just by price appreciation. So right now it's up 5%. So I assume they already.
You didn't like yesterday, is what you're telling me.
Did not like. Was that 2 days ago?
It was 2 days ago.
It was 2 days ago. Yes. Anyway, I'm about to bring in our guest. You guys know what I say here, and I'll say it again, is that you can watch Bobby and I for 25 years. You can think that we are full of shit, and sometimes we think it as well. One thing you cannot deny is we get outstanding guests, and today is no exception. Someone who I've never interviewed before, and I'm very excited about it. Let's bring in Ryan Schiff, who is head of FX at Merrick's. First, we have to get to the important stuff. Do you have any hair-related input to our conversation? What are your thoughts?
I'm with you guys. A little bit, I'm going to be 60. I'm getting gray, and it's a little frustrating, but I'm not going to the dye, and I'm sticking with the short hair. My wife doesn't love the short hair, but you got to
do it.
You just got to cut the sides off and just fight it as long as you can, I think.
Well, if it matters to you, I think you're a fine-looking man, Ryan, by the way, and the hair fits you very well. Are you tall or short?
No, I'm short. I'm like 5'7".
No, same as Bobby. I'm a little bit taller.
He's messing with you on that.
That got nothing out of you, Bobby. That literally got nothing. You got
listen. Anybody who watches our shows, I've put up pictures. Jim and I have spoken on the same stage together. Everybody knows I'm at least 4 inches taller than Jimmy.
Okay, fine. Okay, I think the dollar is an amazing story right now. Brent Johnson, who's a good friend, he sent me a piece that's proprietary and I wasn't allowed to distribute, but explaining about the band that he believes that's about 85 to 110 for the dollar index that puts the least stress on the rest of the world. Can you tell us what your general overview of the dollar is right now?
Well, it's all headline specific at this point. I mean, we've been fighting these war headlines for how long? We have so many people that are fatigued, I would say is the best word, with the war headlines. And I think that for the longest time, it was just sell the dollar and everything was working fine. And now you've got the pain trade, which is dollar going higher. And you see that in the euro yesterday. I mean, we moved down almost a handle. You don't see that very often anymore in the euro. The liquidity is so deep. You don't get these fairly large moves, obviously relative to like crypto or tech stocks. It's not a large move, but relative to an industry that has $9 trillion a day traded, it's a pretty large move. And to me, the pain trade is continued dollar strength. I think a lot of people have been, if you look back on Trump's time in office the first time, he preached strength, but the dollar was actually quite weak during most of his time in office. And I think it's kind of was the same trade here for a long time. And now, we're fighting that for sure, I think.
So I'm always of the belief, Well, I mean, this is not my belief that a dollar wants higher rates, but I think they even like it more when rates are higher than they should be. I know that stocks, I always make the argument that stocks they love lower rates, but really what they love is low rates when rates against a environment that should be higher. What are your thoughts on right now? Why is the dollar high? And is it just because of the rate?
Yeah, I think the perception is that things have turned a little bit. The perception was that with the new Fed chair, we'd get an immediate lower rates. That was back in, say, January and February, that Trump was pressuring him to cut as soon as he got in. He came in and he was, certainly not, I would say he was neutral at best. And I think people are looking at it going, well, now we're going to start pricing in hikes out the curve. The inflation story has yet to really unfold. Like, we still have all this stickiness of tariffs and figuring out what's happening there. We don't, consumer wise in the US, I don't think anyone can deny how bad inflation is, but it is raising the rates going to stop that? Like in my mind, once you're in this state where prices of everything normalize at higher levels, I don't remember a time in my life where they've just come down from there. What ends up happening is eventually they just stop going up. And that's kind of how inflation stops. And then hopefully wages catch up later and things are just more expensive. But anecdotally, try to go to Chipotle or some fast food place that was $7 or $8 to buy a burrito is now 15.
It's crazy.
That's not 3% inflation. That's 50% inflation or 100% inflation for the general consumer. And I think that, that's not going anywhere. Gas is sticky here. Just generally speaking, it feels like everything is more expensive no matter what you do. I don't care if you're playing golf. Like try to play golf publicly in Chicago. It's like $150. Like wow. It's insane.
Oh, okay.
So, and people just, you complain about it, but do you remember it? I give you an example. I think back probably about a decade or so ago when coffee was making new highs. And I don't remember the reason. I think it was just supply shock or there was some rainforest problem or whatever. But Starbucks raised their prices on their coffee. And this is back when I drank Starbucks, which was many years ago. But
I think I remember that. I think it was drought, right?
I think it was drought as well. Yeah.
Like that, yeah. And I remember that Starbucks raised their prices. And the reasoning was, well, it's hard to supply. Supply is pinched off because of the drought. We can't get coffee. Coffee prices are higher. Well, needless to say, we're not still in the same drought. Coffee prices came back down. Did coffee ever go lower? Nope. Starbucks just keeps raising prices. So, it's kind of what the consumer is just stuck in this cyclical cycle, hoping the pricing just doesn't continue higher. And to me, I think that's really kind of the story of what we have going on. And I don't know that raising rates a little bit is really going to change any of that.
And before I pull on this string a little bit more, I want to give you, Ryan, the opportunity to deny any relation to anyone else named Schiff.
Deny.
I thought the same thing when I saw Schiff.
I appreciate you asking so I can clarify that in 100% certainty. No relation. And I might add no relation to the vitamin company, or I probably wouldn't be on here either because I wouldn't be working in FX.
Good call.
I would be spending my historical fortune that was left to me from grandparents. So,
when I was first introduced to Ryan, I said to the guy who introduced us, Matt Engstrom, Jim, you know him as well.
Sure.
I said, wait a minute, any relation? He goes, let me ask him. He comes back. He goes, Ryan said he would have set himself on fire if there was. So that just goes to show you he thinks the same way we do.
Yeah.
The sort of thing, the other day, it was Tuesday of this week, the NYSE has an internal broadcast, like a show, an online show, right? And Jim and I were both on it the same day. Jim, I don't even know if you know that. I was on just before you were on Tuesday. And they asked me the question about inflation. And my response was essentially similar to your story about coffee. And it tells me that there's a structural problem in the U.S. economy. I'm going to blame the government, but I don't really have that worked out in my head yet. Costs only come down. So input costs go up, prices go up. I have no problem with that. Then input costs go down and prices either don't go down at all or they don't go down as fast. Now, I understand why that doesn't happen at gas stations because of my knowledge of crude oil and gasoline and distillates. but it doesn't happen anywhere else. And my theory is that we've made it so much harder for competition to come in and force that to happen. Do you guys, this is for both of you, do you guys think that's a regulatory problem or that my theory is incorrect?
I can start first because owning a restaurant, I can tell you with certainty because I've done a huge study on what it is in the restaurant industry. Prices go up because supplies go up and costs go up. And then when that starts to alleviate, most restaurants have used that time to cut into their own margins for a while too. And they can't wait around for the next shoe to drop and another move of inflation. So it doesn't benefit them or make any sense for them to drop prices. And we won't be dropping prices. And our customers know that. We only raised our prices 25 to 30%, despite the fact that our input costs went up 45%. And that's not just food. Everyone thinks of restaurants as just food. It's energy, it's minimum wage, it's taxes, all of which went up huge. As soon as when we're in a recessionary period, I'm talking about even 2020, as soon as idiot states like Illinois or counties like Cook start to see their money go down, they just raise taxes. They don't think about it because they're fools. Ryan, is there anything you want to add to that?
Just similar experience. I owned a hockey team and we managed the entire facility. So we had, tons of cost as it relates to labor, all sorts of concession items, food, the same when I owned my restaurant, same as you. And yeah, we struggled. I owned the team during the beginning of COVID when we were really in kind of a full-on recession. And, coming out of that, we were forced really to raise prices, and you can't really bring them back down because where are you saving the money? Like, you're already in the hole to begin with. And the thing is, like it or not, the consumer gets used to paying whatever they pay. And, yeah, it stinks for a little while when you raise prices, people complain, but the lines don't really shorten. People have to pay. And the problem that we have in the US, I think, is that, wages have kind of topped out, really. We don't have a lot of people that are able to make significantly more money to cover this. I look at like my kids, for example. Like, it used to be a good thing to make $100 grand a year, like when we were younger, right? That was kind of our goal, right? Yeah. These kids are hoping like $100 grand a year gets them nowhere. Like, they're never buying a house at that rate, no chance, unless you're going to leverage yourself 10x. And guys from our school would say, don't ever do that. You don't want to leverage yourself. Like, I grew up in trading. I don't have any leverage ever. I never, no mortgages, no nothing, because you always know you're as good as your last trade. Like, you could be having a great year. You make one mistake and you're blown out and you don't have another job. So for me, I've never been someone who likes leverage. Even when I opened my restaurant, like, that was very, very low, not levered, just a simple SBA loan. I funded the rest of it. And if we went under, I knew what my risk was completely. There wasn't any, there's no trapdoor risk there. So, I think that's kind of a long-winded way of saying exactly what you said. Just, costs are what they are. And if the restaurant wants to stay in business, they have to raise those costs. So one thing I do take issue with, I would say, is a lot of these Chicago-based restaurants have added that 3% tax.
Drives me bonkers.
Well, just make you laugh. I'm the guy who says, can you remove that from the bill? I don't care if it's $1. I'd rather give that dollar to the server than give it to the restaurant owner. And no offense to you, because I owned a restaurant as well, but I got why they did it during COVID. That's another thing. It's just like the prices. They added it during COVID, much like the new tip on the iPad during COVID. We were trying to do things to make sure that workers were fairly compensated for earning less hours and making their life better, to say thank you for working during such a crazy time. Well, COVID ended years and years ago. Why is that thing still on here? I'm pretty sure if the restaurant's in business, they're making money. Nobody operates a restaurant to lose money. So what do I need to pay the owner 3% for? Yeah. And, I ask my daughter, when I go to dinner with her, she's always like, Dad, are you going to ask at the end about the, and I'm like, yeah, I'm sorry.
Raise your prices 3%. You know
exactly.
What I mean?
Just do anything but stick that on there. I don't need to pay for that.
Yeah.
So anyway, just funny.
I want to throw in, and this is, so people don't know because we haven't got to it yet. And I'm not even sure I want to get deeply into this yet, but we have a question on Twitter from Stocks and Baseball, which, by the way, Stocks and Baseball, the letter N, is a great follow. He puts some really good stuff up there. on X. He said, markets tell me we have Iran fatigue and crypto might be the quote unquote excuse we use for our next decent pullback. Just thinking out loud as usual. I'm not sure that crypto is an excuse for a pullback in tech, but do either one of you guys have any statement on what he said there? I wanted to throw it out there because he specifically tagged me to put it in the show.
I don't know, Dave. I don't know. I like crypto. To me, it seems like tech, when they're not correlated when tech's going higher, but the correlation comes back when tech's going lower, and we're a little bit of a de-risking, which, by the way, is not the most unusual thing in the world. Everybody thinks correlations have to be two-way, but this time it seemed like yesterday, June 23rd, the morning of, when tech was down 3%, crypto was following it. So I think the correlation still exists to the downside, but I don't know the answer to that question. Ryan?
To me, I think I'm pretty deep in crypto personally, and have been trying to, work on onboarding stable coins and things like that. I do believe the FX market, just as an aside, is going to wind up on chain over time, because once you dig into it, the payment systems that we have in FX are so flawed that it is a no-brainer to move everything on chain. That said, my opinion of crypto is that Bitcoin, ETH, the top protocols don't really know investors don't know what they are yet. And I don't mean like they don't understand Bitcoin or they don't understand ETH. What I mean by that is, for a while, it was anti-establishment, right? Those were the people that were in Bitcoin. Then it was heavy speculation, like 2020, 2021, kind of blowing the roof off, Bitcoin making new highs. It's never going to come down. So that was just like taxi cab drivers are telling you got to own ETH, and they're buying Cardano and Sol and some of these altcoins and making tons of money. Well, that crashed. Obviously, that narrative didn't work. Then it was anti-inflation trade for a while. Bitcoin was going to be digital gold. Well, needless to say, that didn't work, since gold went to 5,000 and Bitcoin really was stuck, mired in a range after it made its new highs. So I think that the problem with crypto as a digital asset really just, it needs a defined narrative. And kind of what you were saying, the correlations, negatively, it correlates well with stocks, but it doesn't correlate on the upside. The S&P just made all new highs. Dow just made all new highs. Crypto is sitting 50% off its highs from January. So clearly it's not 100% correlation with risk on assets either. So what actually is it? And I think the problem is that most people don't really understand what the use case is. Originally, the thought was the whole world is going to switch to Bitcoin and you're never going to need dollars again. Well, that's not going to happen. And Trump did a really good job in figuring that out early and creating the Genius Act, which, oh, by the way, also perpetuates treasury buying, which is really smart, given that a lot of people were unloading our treasuries at that point in time. So, I think that people in general, the crypto industry needs to figure out what is the narrative. Like, to me, the narrative is everything is going to wind up on chain, whether it's real world assets, whether it's foreign exchange through stable coins, whatever it is. Like, NFTs were originally like a digital representation of art. Like, that was never going to fly. But if you conceive of buying a home and having the entire title as an NFT on a real world asset online, and being able for me to sell it to you through my digital wallet in 3 seconds and eliminate all of the pain that goes through with signing up for everything, and you being able to borrow your money on chain, either peer-to-peer lending or through another protocol, all of a sudden you have a real use case for crypto. But how is that mark to market vis-a-vis the rest of the assets in the world? And that's where I think people just don't really know where to peg it, which is why it kind of floats between all of these narratives. So I think it's kind of floating in space. I think of it like when you're on maps and you have a bad signal and you're just drifting and you're driving, but the thing isn't moving and you're trying to figure out where you are, hoping it catches up. That's kind of where I feel like crypto is right now.
It's a good metaphor. Bobby, you got a follow up?
Actually, I want to put up a couple of more questions. I do have follow-ups to this, but I want to make sure that we get a lot of interaction on this show, Ryan. And the first thing I want to put up is Papa Doc has a comment. I like that hoodie. So if you want to tell Papa Doc, does anybody know the Papa Doc reference?
No, what is it?
Eminem's 8 Mile, the movie.
Oh, yeah.
His battle rap victory was against Papa Doc from the leaders of the free world.
Yeah.
But anyway.
Okay.
Then Remo, our buddy Remo, It's Stock Charts, another good follow on X. Excessive government spending, U.S. debt is inflationary. Doesn't raising interest rates exacerbate the debt by increasing borrowing costs? So I want to add to that for a second, real quick. And that question plus what I'm going to add is to Ryan. We try really hard, Jim and I, more Jim than me, to explain to people how important following interest rates is to everything that's going on. Jim's an interest rate trader. I'm more of a crude and stock trader, but we're always telling people the interest rates are the things you need to keep your eyes on, and it tells you kind of what may be coming down the pipe. First of all, what in FX are we missing that may be doing the same thing? Your average person doesn't look at FX on a day-to-day basis. And then what do you think about isn't debt increasing borrowing costs, raising rates, increasing borrowing costs, exacerbate the debt problem?
Well, and that's the whole conundrum of our economy, isn't it? Like we need to tap the brakes in order to stop inflation. But once you do that with $39 trillion in debt, all of a sudden your debt becomes a debt that you can't pay. And that's the real risk, which is why the dollar was selling off so aggressively earlier, let's say 6 months ago. And, now what do you do? How do you stop the train? I don't know that there is a way to stop the train, which, again, pointing back to the crypto narrative, I think that was the original, since there's no stopping this train. That was the beauty of the whole Bitcoin conversation, was that's the asset that people can flow to because it's not governed by the government. It's just, it's nobody can be involved in it. Basically, it's got a number of coins and that's it. So I do think interest rates are the thing to watch for in FX. And I guess you'd probably say the same about crude and equities for that matter, maybe less so in equities because of the giant retail bias to the upside. But in FX, because there's a lot of two-way flow and because there is a gigantic amount of liquidity for the most part in the G20 at least, I think that not only is interest rate something to watch, especially when you have changes like we've just been through, where we were expecting lower rates. We kind of need lower rates to lower the cost of our debt. By the same token, the fear of inflation is still hanging around, so maybe there's a chance. So when you get in those indecisive cycles, those are things to watch for, especially vis-a-vis the other currencies involved, who's raising rates, who's lowering rates, because then you get the carry trades. The carry trade unwinds are usually the most difficult moves to stomach in the market because I think a lot of people pile into those carry trades, and there's a lot of guys that are late to it and they get caught in the wash when it unwinds. I would say also that FX, in my experience, which is like getting close to 40 years now, the pain trade is the one that always hits. Like, it's just the one thing you think can't happen, like inevitably it does. And I don't think it's as much in equities. Like, you think about stocks like Apple or Google and whatever, the pain trade is obviously materially lower, but there always seems to be a retail bias to buy these stocks. And there are always people waiting to get them cheaper who didn't get in before and want to get in now. So I don't feel like you get that as much as equities. Maybe I don't follow crude as much, and you might have a different opinion or say it's the same, but I feel like the pain trade is what pushes a lot of people in FX, and also the unwind of carry trades.
There's one thing that this isn't a pushback, because I like what you just said about the retail biases to the upside in equities. But I've always explained to people that equities naturally go lower left to upper right for two reasons. One, what you just said, which I rarely mention, but the other is that every company that's within the stock market is trying to at any one time shed underperforming assets, replace them with other. It's like an engine that's embedded in the stock market that's built for more profitability. That's in there too. It's not just retail and passive investing that's driving it higher as well. You'll give me that, right?
Yeah, 100%.
Okay. So the other thing I wanted to talk to you about the dollar, I want to go back a year when the euro made that unbelievable run from about 100 to 115 2 weeks before I was going to Italy. I thought it was the screw Jim Iuorio trade and make his vacation 15% more expensive. But I didn't get it at the time. Why in the world would Europe be attracting the world's investment? To me, it seems like every country that's developed in Europe except for Poland is just regulatory hurdles a mile high. To me, it seems like it's a museum. It's not even ever going to be a factor in the global commerce war again.
I couldn't agree with you more. And it was quite a pain trade because it did not make a ton of sense fundamentally. I would say, again, you're talking about right when Trump took office, right, for the most part.
Mhm.
So I think there was a euphoria back in November before, right when he was elected. And then the reality of him coming into office pushed people a little bit past their comfort and wound up, the dollar wound up selling off, which is exactly what happened in his prior regime. I think there is that worry of, he's just unpredictable. And I think that while I think in the end, he's probably going to wind up being right about a lot of the things he said, but, between the thought of tariffs and what was going to happen with that, I think there was just a lot of uncertainty. And, it was just,
Okay.
Europe didn't have that level of uncertainty, even though to compare Europe with us and want to own Europe over the US in general wouldn't make a lot of sense. It
doesn't make right. Let's take a quick break, pause here. Luis, can you put up the banner? You guys know this part of the show that I always make a plea for you guys to support us on this show by scanning that QR code and trying Tradier Pro for free for 3 months. We talk to people who've traded options for decades and those who've traded it for days, and they all say the same thing about Tradier's platform, is that it is amazing. It's the gold standard for options trading platforms. Please give it a try, whether you're interested in it or just as a favor to us. But please give it a try. 3 months for free. Thank you. And now back to the show. Bobby?
Ryan, in my opinion, that there's always the third thing that I didn't even want to say retail. I think just generally active investors are missing. For example, gold is an inflation hedge. No, not when the Fed is fighting inflation, not when they're raising rates. It's not an inflation hedge. Interest rates move, if the Fed hikes interest rates, the 10-year will go higher as well on its yield. No, it won't. Not if the market believes that the Fed needed to cut more or hike more. There's always a third factor. What's the third factor in interest rates? Is it yield differentials? I'm sorry, in currencies. Is it yield differentials? Is it central bank dynamics? I mean, we saw the ECB hike rates and we saw the euro weaken. And then we saw the US central bank not do anything, but maybe lean that way, and the euro weakened even more. So what's that sort of other thing?
Yeah. There's that thing that if you're hiking rates, your economy is going to slow. So, what becomes more important in the currency trade? Is it the fact that you can get better yield by holding the euro? Or is it more important to get out of the euro because the economy is going to slow and it's not going to be doing well? So the other thing is figuring out, it's like an algebraic equation, which is more important, X or Y, because both of them have different effects, right? Raising rates is good for yield, but it's not great for the economy. So do you want to own something that maybe the economy is going to move lower, or do you want to hold something for the carry trade? And that's what I was saying before, where, carry trades like euro against yen, or, whatever, interest rate against interest rate, you're holding the currency with the higher interest rate and selling the one with the lower one with the intent to earn that interest rate differential every day. And it's a trade as old as time. But when those unwind, and like what you were saying about, what happens to the 10-year when the Fed raises rates? Well, the market's long priced all of that in most of the time. I mean, the US isn't one to surprise markets beyond irrational exuberance, whatever that was 30 years ago. In general, everything is pretty well telegraphed. So anyone waiting for the actual thing to happen to make a trade or to get involved generally is going to be the guy that gets washed out, right? So to me, I think that, the same goes for the carry trades. Those unwinds are really painful because a lot of people are in them for kind of the wrong reason. They're trying to earn yield, but they're holding an asset that they don't really know anything about. They just know that it yields higher. And, I would equate it to I laugh, but the staking in crypto, a lot of people are holding ETH and staking it for 2.5%. Well, how does that help you if ETH goes from 4,000 to 2,000? You just lost 50%. It's going to take you 25 years to make that back.
It's very similar to people who just look for dividend paying stocks.
Exactly. Yeah, it's a perfect analogy. Yep.
I just want to.
Papadoc asked about the Swissy being part of the carry trade. I always think in terms of the yen. Ryan, do you have an answer to that?
Yeah, it depends what you're trading it against. In general, Swiss is a flight to quality currency, so it's not generally speaking, one of the things that people trade for yield, so to speak. And for years, the yen has been like zero interest rates or negative for so long that it was always a carry trade against yen. Most recently, that's changed as the Bank of Japan has switched their bias and has been starting to tighten rates. So, that trade got unwound. And, people that were in it long term, it was a little bit painful to watch that unwind.
Oh, wait. So hold it. So because I still think, yes, the rate differential is not as advantageous against Japan, but that currency is still a pig. We don't even talk about it as being a safe haven anymore.
Remember, they're intervening left, right, and center to keep it, to just keep it under control.
So Luke Groman and myself, to a lesser extent, because he's Luke Groman, he believes that part of the carry trade over the last few years was borrow that yen, sell that yen for dollars, and take that dollars to buy tech stocks. Do you believe there's any validity to that?
Sure, why not?
Why not, right?
If you like leverage, that's a good way to lever at low rates.
Yeah. Okay. That's what I think too. And I've been writing in unfilteredinvestor.com that there's probably a level of the yen that flips the switch on that part of the carry trade. I don't know what it would be.
Smart investors, that are willing to take on leverage, obviously you want leverage at the cheapest possible cost. So, I'm not one of those guys, so I don't follow those trades, but I can understand people that do like leverage doing that. I think that makes a ton of sense. And, I think too, that has a lot to do with what's happened in crypto in the last little while. There were a lot of levered positions across the board at varying levels of interest rates. And, there's tons of ways to gain leverage in crypto. Why you would trade on leverage in crypto is beyond me when you have assets that move 5 or 7% in a day. And that's the largest assets. Like if you want real juice, go down the curve and trade a meme coin. They move 70% in a day. What do you need leverage for? But for some reason, people find it really appealing to go out there and lever $100 bet at 100 to 1 on a meme coin. I get it. If you hit that hard 8 once, you want to hit it again. It makes sense, but it's certainly not. I wouldn't say that's an investment strategy, but people do it.
Widge, I'm going to put your comment up. Widge is one of our smartest viewers and one of our most regular viewers, but then I want to get into a question as well. Luis, if you could put that up. He put a massive error of this administration has been to rely on executive orders and courts for tariff policy. Nothing was codified, and all of this will be reversed in the snap of a finger. As soon as it was reversed, he found other angles to put different tariffs on. So I think the midterms is going to be sort of the tipping point for that. Anybody got anything to say to comment this?
Not really. I I think Widge is right. I know that he and I are both angry about a lot of the things that the president has done. I think he's further out the anger curve. But I agree with you on this one, Widge.
Yeah. I have nothing to add. I agree with you as well. It's too easy to reverse all of this. And
by the way, Florida is a really good test case for all of this stuff because they just passed through the state House and Senate a measure to eliminate $150,000 of your house's value when it comes to property taxes.
Love that.
So the first $150,000 is now property tax free. And it's supposed to go up to $250,000 by 2027. That's already codified in the law. And so they're already moving to collecting fewer taxes and moving into more of a sales tax state. There's already no income tax down here. And it's going to be a problem for a lot of other states and the federal government as well as to why a state this large, Ryan, I think you know this, I'm in Florida now, why a state this large can continue to get away with that. And I know there'll be people out there going, well, they don't have this and they do have that. It's like, just stop. Okay. Yeah. Any excuse that the government is spending money wisely, fucking stop it, because they're not.
Yeah.
Anyway, I do want to get into some more detail on the crypto side of things with you. Jeffrey Tucker, who's been on our show a couple of times, he writes for the Epic Times, and he's just a unbelievably smart guy, was an absolute devotee of Bitcoin and crypto in general in the early 2010-ish area, right? And in 2013, he said he finally finished all his research and he just was in with both feet. He loved it. He thought it was the greatest thing. 2017, he said, was the tipping point for him. And it's interesting because Bitcoin specifically operated on, I would say, mostly speculation from about 2017, 18 on through COVID and through this last decline. He says that that was sort of the fork. He called it the block size war in an article that he wrote. Do you remember that?
I
Where
wasn't in
sort of
crypto
Bitcoin
in
Cash.
2017. I wish I could say I was. I really didn't get heavily involved in crypto until about mid 2020, I would say. So I can't really
Okay,
speak
so
on that. So
basically what it was basically when Bitcoin Cash, the people who didn't like the direction Bitcoin was going and started becoming devotees of Bitcoin Cash, which is another coin. And his argument was when the focus of Bitcoin stopped being,
Speculation.
well, no, it started being speculation.
okay.
It
It
stopped
stopped
being
being a store of
acceptance.
value and
Yeah.
like anti-establishment. We don't want the government controlling our
Right.
money. It became rampant speculation.
Yeah, it became speculation, and they started saying things like, well, it's not about adoption now, it's about store of value. To him, he said that was where it changed.
I
And it was
agree.
interesting to me because I speak at a few of these things. Jim has spoken at some as well. I've spoken at 3 in the last 6 months, 3 Bitcoin conferences in the last 6 months. I've got one July 1st again, and they always bring me in as the skeptic. Now, that's because in their Bitcoin conferences, I am the closest thing to a skeptic that there is, even though I have been involved in crypto here and there, right? But I come in and I sort of embrace the role. And what they're asking me to talk about now is, or rather, they want me to talk about whatever I want to. I'm the only speaker at this next one. And what my point is going to be is, why did you guys let this get into it's only speculation and it's only store of value? All right. What are your thoughts on that? Because Bitcoin has just gotten below the 200-week moving average, and it hasn't closed below it in what I consider to be a method of certainty from a technical analysis standpoint. I can even put it up. But the last time it spent any real time below its 200-week moving average, it went down another 44% from there, which would put it in the mid 33,000 range or so, which I think is catastrophic for the rest of the speculators that are left. And it could trigger sailor selling some, which we could talk about why that is later. Yeah. So what do you think of my argument that that's when they started to cause a problem, when they started to say it's a store of value? Because if it doesn't keep going up, then, what are they talking about?
Yeah. Why? So I think you have a good argument there. I would say too that around that 2017, 2018 timeframe is when Ethereum started to become kind of a real competitor, let's say, to Bitcoin, even though it really shouldn't be, because it was completely different. And then around 2021 was when they switched to the proof of stake model. And to me, what ETH has done that's smart, that kind of dovetails with your argument, is ETH is like the enterprise edition. Everything is being built on ETH. If you look at everything the government is doing from a stablecoin perspective, if you look at everything BlackRock is doing from a real world assets on chain perspective, every single thing is being built on Ethereum. And I think where Bitcoin misses that is it's slow, it's cumbersome, and it is just one thing. It's only a store of value, and you could never really build on Bitcoin because of the proof of work thesis behind it. But the security of it and the way that it works is doing exactly what it was supposed to do. And I think it wasn't by choice that the market switched that thesis. It was just because other technologies emerged that offer better opportunity to rebuild our TradFi economy, for lack of a better word, on chain. And even looking at Solana is a little bit different of an avenue there. It's much, much faster, arguably less secure, arguably less stable, but materially faster. So if the equities are ever going to trade on chain, like fully on chain, Solana is a logical choice there because of how fast it is and how cheap it is. I mean, it's literally 0.00001 cent to do anything on there. So I don't think that the Bitcoiners, or the maxis as they're commonly referred to, really changed ever what they thought of it. I think that the market evolved and brought new things into comparison with Bitcoin, and it's still the OG. I mean, at the end of the day, Bitcoin, if you had to put money in one thing, it's hard to argue that you wouldn't put it in Bitcoin at these levels.
You say one thing, you mean one cryptocurrency? One
crypto, yeah.
Okay.
I mean, one crypto. It's hard to argue that, I don't think Bitcoin is going to zero again. Might it go down to 30,000? It might, but man, we are really oversold at these levels. Like I think, fear and greed index is what, around 14 today or 15. Historically, it doesn't stay at that level very long. I suspect that we've flushed out a lot of weak longs here below 60,000. I wouldn't be shocked if we saw it below 50,000, but 30 seems like a stretch to me, but who knows,
So there's one question I have before I want to get to the book talk, because it seems fascinating to me. But Bitcoin, we could make the argument that Bitcoin does not like higher rates. Okay, hold it. Let me retrace that for a second and talk about Bobby's thesis on gold and why I think we're in the exact mirror image, Alice, the looking glass, whatever situation right now. Bobby always argues that saying gold likes low interest rates is incomplete. Saying gold likes low interest rate, no, it's saying inflation is incomplete. Gold likes it when inflation is present and the Fed has no intention of jumping in to slow it down. That's when gold does the best. Now, flip to where we are now, where the Fed, we're pricing in a hike that is going against inflation that I feel is already dissipating. Crude now is $70 a barrel right now. I think technology, as far as AI, is going to make companies more efficient, increase productivity. That'll be disinflationary. So I think gold hates when the Fed is fighting inflation with a possible hike, when inflation isn't really even traditional inflation, even if it exists in some other world. Is Bitcoin falling into that same thing? Is there a correlation with gold on the downside? Not on the upside. We know there wasn't back in January, but on the downside, is that correlation there?
Could be. And I think what also hurts that is that most of the people that aren't OGs in Bitcoin are in from higher levels than here.
They're underwater, right? Yeah.
And, that pain trade, like I talked about in FX, is real. Like, you had a lot of people, when the cab drivers are talking about buying Bitcoin, that's probably time to be getting out. I remember that in the 2000 stock market when cab driver was telling me about like pet.com or something, like, and he's like, oh, it's the best stock. They're going to revolutionize the pet industry. And you're just sitting there like, this is the cab driver telling me how much money he's making in stocks. Kind of like The Big Short, when, you had the various people buying, 3 and 4 condos and just not even.
You don't think you can say the stripper on the show? The stripper.
Yeah, it was a stripper. Yeah.
It's a legit profession.
Yes.
They're dancers, Jim.
Yes.
Dancers.
Our partner in the Unfiltered Investor newsletter, Mike Arnold, still has one of those pet.com puppets that they gave out to people back in the day. He's still got one up on his shelf. There is a conversation out there about Michael Saylor saying that he would never sell Bitcoin ever unless the net asset value went below $1 in his fund. And he's approaching that. Yeah. Now, I don't know if that's going to happen or not. I just know that would, for it to get out in the news that he's selling more than he's already sold, that may be the driver down to the mid 30,000 range. And I hope it clears those people out.
I saw him speak in Dubai back in December at a conference, and man, if you don't know better and you listen to him, you're going to put all your assets in.
He's so certain. That's what I hate.
He's just so certain. Like he's like just so certain. And, he may or may not be right in the long haul. We'll see if he's genius or fool. But I will say that, stretch trading down to $80 today is a worrisome crack in the mortar.
What's stretch?
STRC.
That's
basically their Bitcoin fundraising model. It's what he
calls strategy. From Michael,
he calls it a bank account that's not at a bank, and it pays you an 11.5%. Right now, it's at 11.5%. I'm guessing it's going to have to be raised to 14 or so just to get it back to par value, because it's supposed to trade at par value. You put your money in, you never really take it out, and the idea is you get 11.5% a year. And his thesis is, I'm going to take your money and I'm going to buy Bitcoin with that. Bitcoin goes up 27% annually year over year, and I'm happy to pay you 11.5%. Well, when you hear him tell it, it's an amazing story, because over the lifetime of Bitcoin, that's actually happened. Your year over year returns, even so long as he's been in Bitcoin, which isn't much. He got in a little before I started getting in. So, he didn't catch it from $10 either. However, this year, he's down 50%, and he's still been buying. He was buying above 100. He was buying above 110, and he's below his average. So at what he had when I was there, he was down to about, I think he said he had 4 years worth of dividends paid for. I read today that at $80, stretches down to about 7 months of runway to pay those 11.5% dividends.
Wow.
If
Stress.
that
The rope is
collapses
pulled
down
pretty
to 1 or
tight.
2 months, he has no choice but to sell material amounts of Bitcoin, because he was originally owing 300 million a year. Now I think it's 1.5 billion a year. So granted, he has what, 740,000 Bitcoin or 840,000 Bitcoin. So there's a lot in the war chest. It's going to take a lot to kill this guy, but it's definitely showing, some cracks in the mortar across the board on Sailor's Empire. And, again, back to the pain trade. One thing I've learned in 40 years or so of being in the markets is the pain trades, as unlikely as they normally are, somehow have a way of coming to fruition.
No, and I like
Cliches
that.
are based on truth, are they not?
There's no question, right? And when I hear the people like Michael Saylor and even Kathy Wood to a lesser extent, when they speak and Peter Schiff, your twin brother Peter Schiff, when he's Ryan is not related to Peter Schiff at all. And I think Peter Schiff, and I know him. I appear at the same conference for 10 years in a row. We talk. I think that again, he's predicted two out of the last 50 recessions, or however you say that thing. But anyway, I think that I steer away from those people who are certain. Now we're talking about the book. The book is called A Fool's Errand, a neighbor, a top 100, that's a chase, a different scorecard by Ryan Schiff, no relation to Peter Schiff. Can you tell us a little bit about the book, what motivated you, et cetera?
Yeah. I think in the beginning of the show, you mentioned that I've done a few things. I've owned a restaurant. I owned a hockey team. I owned a shampoo company.
By the way, you say hockey like a Canadian. Are you from Canada?
No. I'm originally from Long Island, New York.
Okay. Do you just hang out with a lot of Canadians?
I played college hockey with a lot of guys from Canada, and I played some minor pro before I got into FX. So been around a lot of Canadians my whole life. My son played junior over there. So, I lived there when I played junior as well. So, but yeah, I've done a lot of things, and it's funny. I was listening to a podcast, the Golfer's Journal. It's Broken Tea Society. I don't know if you guys are familiar with it, Tom Coyne, but he had a guy on there talking about fly fishing, not golf, even though I'm a pretty big golfer. And I really enjoyed the podcast. And he was basically comparing the things he's learned in fly fishing over an entire lifetime of fly fishing, which I've been once, and I'm not very good at it, but I've been enough to kind of grasp what he was saying and how it really materially impacted his life. And I listened to it, and while I was listening to the whole podcast, I was thinking to myself, golf kind of has that same effect on me, and I'll bet it has on a lot of people. And I've been doing a lot of thinking about it, and I just sat down and started to write, and I thought, I bet I could write a book about this. I don't really want to be a podcaster, but I bet I could write a book about this. And I started writing and got in kind of a really good flow state, and I started with my childhood in golf, and went through kind of working in golf as a caddy, playing municipal golf courses, and meandering into private golf clubs, and kind of my working years and a lot of my experiences. And then it flowed into relationships built with friends, time spent with my kids, my two boys especially. My daughter doesn't really play golf, but my sons are huge golfers, and we've been on many trips together. My father-in-law and I have a relationship that is 40 years old and has been materially impacted by golf. And just all of these things kind of crystallized in my head around golf and life lessons. So the book in and of itself just sort of happened as a result of listening to that podcast. And I wasn't sure what I was going to do with it. I wrote it in about 3 or 4 weeks. It was really pretty quick, because it was just like, I didn't have to do any research. It was my stories. So it was pretty easy. People are always like, you wrote a book in 3 weeks. I'm like, wasn't that hard. I just put my stories on paper. It wasn't, it was all from memory. It wasn't crazy. And fortunately for me, I think a lot of the stories are both heartwarming and funny. So there's a lot of funny stuff in that book. There are some hilarious moments, talking about driving a car on the wrong side of the road, shifting with my left hand in Ireland and trying to avoid, stone walls, and, playing in Ireland and getting hailed on by golf ball size hail, and funny events with my sons on golf trips and my friends on golf trips that are hilarious. But there's also a lot of heartwarming moments in there. And the book starts with me, my introduction to golf as a 12-year-old, when I really didn't know anything about golf. My neighbor took me to play. Yeah. And he took me to play, and I learned to play through him. And he was just this very interesting man who I hardly really knew. He took me to play maybe 3 or 4 times that summer, and he taught me things without teaching me, and ultimately without giving away the whole premise of the book. It starts there and kind of finishes back around after a lifetime of golf, thinking back to the things I learned from my 70-year-old neighbor.
Well, was there any like a wax on, wax off moment with the 7-year-old
like
neighbor?
It really is. It's kind of like that. Like you think back and really, I chased the top 100 courses, and I won't tell you whether I finished the top 100 or not. You'll read it in the book, but in doing so, I'm kind of an obsessive compulsive sometimes and highly competitive. So I was really going after it for a really long time. And what I learned looking back on that was that the chase was never really the point. What the point was the relationships that were made through golf that have lasted the test of time. And some of my best friends now, besides the guys I played hockey with early in my life, are all guys I've met through golf and continue to be one text away from meeting here or there to play golf. And the meaningful impact it's had on my relationship with my sons and my father-in-law and a variety of other people throughout my life, not only in business, but also just in friendship. So, it's a lot of realization. And I think it's funny, a gal who lived with us when my 3rd kid was born, kind of a long story, but a family friend of my wife's growing up. My wife had babysat for her, and my youngest was born with a congenital heart defect and needed open heart surgery at 11 weeks old. And when we went through that surgery, we brought him home shortly after, and it was like all hands on deck with my wife and I. He's 24 now, thank God. He's pretty healthy, and he had one more surgery, but he's actually had several, but only one more open heart. But cut a long story short, she came and lived with us and helped us manage the other 2 kids while we were trying to deal with, a very sick 11-week-old. And I just got a text from her today, and I don't think she's ever played golf in her whole life. And she said, "I'm reading your book. I'm like 9 chapters in. I have laughed and cried more times than I remember. And I'm just really loving this book. And I don't know anything about golf." And I thought, okay, that's kind of what I was going for. Like, the golfers are obviously going to like it because they'll laugh at the stories and they'll love the chase and that kind of thing and the lessons learned. But if non-golfers can text me and say they really enjoyed it, then I think I'm onto something. So
I got to jump in here, Ryan, because, the person that introduced us, he said to me, yeah, he's written this book and he told me about it. So I went online and bought it. By the way, it's not an expensive book. Okay, no, it's an inexpensive book. I think it's under $12 or $13.
It's $6.99 for an ebook, and it's $15.99 for paperback.
Okay, I bought. You know me, Jimmy. I gotta hold the book, right?
Yeah, I gotta listen to it. Is it on Audible yet or no?
It's not yet. My son, who does a podcast, is going to help me do it on Audible, but that probably won't be for another couple of weeks.
All right, so I bought this book. Now, I quit golf. A lot of people who know me know this story. I used to play golf all the time. And then when I got divorced from my first wife, I realized the only thing I liked about golf was it was 5.5 hours away from her where she didn't bother me, right? And now I'm married again, and I really like this wife. So I don't play golf, but she likes golf, right? And I'm like, nah, I just don't want to do it. I read one chapter of this book, and I called Ryan. I'd already spoken to him. We'd already set up this, interview. And I called Ryan. I said, I might play golf. And I want to read part of the first paragraph. Can I say his name, the old man?
Mr. Maneri, yeah.
Go ahead. Mr. Maneri. So I was going to read this part, Jimmy, and I've never done this with a book we've talked about before. But basically, the end of the first chapter says, Mr. Maneri was far from a world-class player, but I think he was certainly a world-class teacher. He taught me all the important things about golf, none of which had anything to do with the swing, ball flight, apex of the shot, weight transfer, or anything else golfers spend hours thinking about. He taught me how to love the game and more so to enjoy the people you play with. He taught me how to be present and purposeful on the course, take in the scenery, and enjoy the rhythm of the round. Most of all, he taught me how to count and savor the great memories, like making par, because they keep you coming back. That's what I read. I, like Ryan, am extremely competitive. And another reason I quit golf, if I'm being truthful, is I couldn't get good. But this older gentleman, excuse me, this Mr. Maneri, only counted pars and didn't keep score. I read that chapter and I'm like, I call my wife. I'm like, I'm going to start playing golf with you, but I'm not keeping score. So there's actually a new golf convert from one chapter of
I love it.
this
And that's
book.
on the front. It
One
says
chapter.
different scorecard is the last thing in the subtitle, and that's kind of the thesis of the book. Is after all this time and chasing lower scores and a better handicap, and whatever, what you realize is go out and enjoy yourself, enjoy the people you're with, count your pars. Does it really matter if you shoot 78, 88, or 98? It doesn't. It's more about where your feet are and who you're with than it is about what you shot. And golf is such a cool game like that because that's the whole handicap system. It works for a reason. A 20 handicap can beat a scratch golfer any day on a net basis. So if that's the case, then what are we worried about? Just go out and enjoy yourself and have some fun and count your strokes and count your pars rather than your strokes. And, I try to tell my boys, be where your feet are. Enjoy this moment.
I love that.
And
but
forward from Jim
easy.
Craig, the Miracle on Ice. Jim Craig, by the way, wrote the forward for this.
Jim and I have played a lot of golf together over the years. He's a really good guy. And it was very nice of him to do that.
That's really cool. I've played probably 3 or 4 times a year for 40 years. I've probably played 150 times. I can count my pars pretty easy, maybe 12. That's what I'll say. So maybe I'll go out to the range today. Actually, I might go out to the range today. I've got this pinky thing going on.
Oh yeah,
what happened there?
So I'm not. It's happened years ago playing basketball, but then my dogs got in a fight about 2 months ago, and when I was finished breaking up the fight, my finger was bent sideways. And my wife is like, what happened? I'm like, have you ever been in a dog fight before? You don't know what happened. I'm sure for that 30 seconds, it's like being on the beaches in Normandy. I'm not really trying to equate with that, but it's pretty intense. Yeah. So, but anyway, the book is called A Fool's Errand. The author is Ryan Schiff. That's not why he's on the show. He's on the show because he's also an FX expert. And please take a look at the book. I'm excited about reading it right away. And I think it's going to be very, very cool. Ryan, tell the people where they can get it on, just on Amazon, right?
You can get it anywhere. You can get it. Amazon is probably the easiest, but I think it's literally available pretty much anywhere. If you go on Barnes and Nobles or,
Aren't you like the number 4 golf book right now or something?
I was up to number 2 last week, only behind Rory. And I think I'm number 3 right now. So Tiger and Jack jumped in front of me. But 39 majors between the 3 of those guys. That's probably as many times as I've broken 80. So I think that's probably fair.
That's fantastic. I am Jim Iuorio. That's Bob Iaccino. This has been The Trader's Edge. Thank you guys so much for joining us.
Thank you for having me.
Pleasure's mine. Pleasure's ours.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.